What are bonds? Bonds investment explained. When you buy a bond, you are giving the person who made the bond a loan. The person who made the bond has promised to pay you interest and give you your money back on a certain date in the future. Bonds don't get as much attention in the news as stocks do, but by market capitalization, the global bond market is bigger than the equity market. In 2018, the Securities Industry and Financial Markets Association said that the value of the world's stock markets was $74.7 trillion and that the value of the world's bond markets was $102.8 trillion. In today's videos, we are going to talk about what are bonds? Bonds investment explained. So let's get started. Bonds are investments in which an investor lends money to a company or government for a set amount of time in exchange for regular interest payments. When the bond matures, the bond issuer gives the money back to the investor. Bonds are often called fixed income investments because they give you fixed payments over the life of the bond. Bonds, especially investment-grade bonds, are a key part of a well-rounded investment portfolio because they are a lower-risk investment than stocks. Bonds can reduce the risk of investments like stocks that are more volatile, and they can give you a steady stream of income during your retirement years while keeping your capital safe. There are almost too many different kinds of bonds to count. In the US, there are 4 main types of investment-grade bonds based on who issues them: corporations, the government, agencies, and local governments. These 4 types of bonds are also taxed differently, which is an important thing for bond investors to think about. Corporate bonds. Corporate bonds are issued by both public and private companies to pay for day-to-day operations, to increase production, to fund research, or to pay for acquisitions. Both the federal government and each state tax the income from corporate bonds. Government bonds. The federal government is the one that gives out U.S. government bonds. They are often called treasuries because the U.S. Treasury Department puts them out. The money from the sale of treasuries pays for everything the government does. They have to pay taxes to the federal government, but not to the state or city. Agency bonds. Government-sponsored enterprises like Fannie Mae and Freddie Mac sell agency bonds to pay for federal programs that lend money for mortgages, education, and farming. Some of these bonds are taxed at the state and local level, but not at the federal level. Municipal bonds. Municipal bonds are used to pay for projects in states, cities, and counties. Municipal bond interest is tax-free at the federal level, and in many cases at the state level as well. This makes them a good choice for investors with a lot of money and those who want tax-free income in retirement. Bond funds are mutual funds that usually invest in a wide range of bonds, such as corporate, municipal, treasury, or junk bonds. The interest rates on bond funds are usually higher than those on bank accounts, money market accounts, and certificates of deposit. Junk bonds are a type of corporate bond with a high yield and a rating below investment grade. Junk bonds have higher yields than investment-grade bonds, but their name comes from the fact that they are more likely to go bad. Investors who don't like taking risks as much might not want to buy junk bonds. There are some tips for investing in bonds. Know when your bonds are due. The date of maturity is when your money will be given back to you. Before you put your money in the bond, you should know how long it will be tied down in it. Find out how the bond is rated. The rating of a bond shows how likely it is to be paid back. The higher the risk that the bond will default and you'll lose your investment, the lower the rating. Using the Standard & Poor's rating system, AAA is the best rating. Any bond with a rating of C or lower is called a junk bond and has the highest chance of not being paid back. Understand your tolerance for risk. Bonds with a lower credit rating tend to have a higher yield to make up for the fact that they are riskier. Think carefully about how much risk you are willing to take and don't invest based on yield alone. Think about the big picture. When interest rates go up, the value of bonds goes down. Interest rate risk is the chance that interest rates will change before the bond matures. But don't try to time the market because it's hard to know how interest rates will change. Instead, you should concentrate on your long-term investment goals. Bonds are also at risk when inflation goes up. Support your broader investment objectives. Bonds should help you balance out your investments in stocks and other asset classes and spread out your risk. You might want to use an asset allocation calculator based on age to make sure that your portfolio is well balanced. Read the prospectus carefully. If you want to put money into a bond fund, you should look at the fees and see what kinds of bonds are in the fund. The name of the fund might not tell you everything you need to know. For example, some government bond funds also hold bonds from other countries. Use a broker who specializes in bonds. Hire a broker who knows a lot about bonds. Choose a company that knows the bond market if you want to buy individual bonds. You can use FINRA Broker Check to find reliable people who can help you open a brokerage account. Investing in bonds offers a host of advantages. Capital preservation. Capital preservation means protecting the value of your investment as a whole by buying assets that promise to give you back your original investment. Bonds tend to be less risky than stocks, so they can be a good choice for investors who don't have much time to make up for losses. Income generation. Bonds give you a fixed amount of money every few months in the form of coupons. Diversification. Investing in a mix of stocks, bonds, and other asset classes can help you build a portfolio that seeks returns and is stable in all market conditions. Stocks and bonds tend to go in opposite directions, which means that when the stock market goes down, bonds look better. Risk management. Most people agree that fixed income is less risky than stocks. This is because fixed income assets are usually less affected by macroeconomic risks like economic downturns and geopolitical events. What are risks associated with investing in bonds? As with any investment, buying bonds also entails risks. Interest rate risk. When interest rates go up, bond prices go down, and bonds you already own could lose value. Changes in bond prices are mostly caused by changes in interest rates. Inflation is the rate at which goods and services get more expensive over time. If the rate of inflation is higher than the fixed income from a bond, the investor's purchasing power goes down. Credit risk, which is also called business risk or financial risk, is the chance that an issuer won't pay back its debt. Liquidity risk is the chance that an investor wants to sell a bond but can't find someone else to buy it. Bonds usually earn less money than stocks. From 1928 to 2010, the average return on stocks was 11.3%, while the average return on bonds was 5.28%. Bonds keep your money safe for a set amount of time. If you buy a 10-year bond, you can't get your money back for 10 years. This makes it possible that your initial investment could go down in value. The opposite is true for stocks, which can be sold at any time. Where can we buy bonds? Stocks are traded on a centralized market, which means that all trades go to one exchange and are bought and sold at the same price. Bonds are not traded on an exchange like stocks are. Bonds, on the other hand, are not traded on stock exchanges. Instead, they are bought and sold through brokers. U.S. Treasury bonds can be bought directly from the government, though. The bond market is regulated by the Financial Industry Regulatory Authority. As soon as the information is available, FINRA posts the prices of transactions, but the data may be behind the market, which makes it hard to know what a fair price is when you want to invest. That's all for today. I hope you liked the video. If you did, make sure to hit that like button and subscribe to the channel so that you never miss any amazing video from us.